SpaceX just broke the record for the largest IPO in history. Not only that, we have OpenAI potentially IPOing in 2026. And before that, we have Anthropic scheduled to IPO in October of 2026. With all of these big IPOs on the horizon, it's time to answer a very popular question during these periods, which is, do IPO manias cause market tops, or do they occur at market tops? So, as I mentioned, three big IPOs on the dock for 2026. SpaceX just completed the largest IPO in history. They raised around $86 billion at a $1.75 trillion valuation. Anthropic has actually filed their S1 to IPO in October of this year. They're looking at about a $1 trillion valuation. And then OpenAI, same thing, around $1 trillion valuation. And it's not just these IPOs. We're going to focus on the IPOs. But another thing that happened is Google, or Alphabet, just raised about $80 billion in an equity issuance to help their AI rollout. So I would not be surprised if we see some of the other large hyperscalers like Amazon, Microsoft, etc., try to front run some of these other AI IPOs. There is a limited amount of capital out there, believe it or not, and these guys are often chasing after the same dollars. So, are IPOs a sign of a market top? Well, first we need to explore what are some of the main reasons why a company might IPO. These are not all of the reasons. These are just some of the reasons. I think there's a lot of the major reasons, but let's go through them. So access to deeper, more liquid pools of capital. Now, this was traditionally true. The public markets were often the only place that these companies could raise these mega rounds. What we've seen in recent years is the explosion in the size of the private markets. So now companies are able to stay private for longer and raise much larger, more vast sums of money before they even try to go public. That's why you're seeing companies go public, like SpaceX, at a $1.75 trillion valuation. It's because they're able to do more and more rounds in the private market. So number one here, while traditionally a huge reason and still might be relevant, maybe less relevant than it was a decade or two or three ago. Number two, I think this is a big one, liquidity for early investors, founders, and employees. A lot of time in the private markets, private investors will continue to invest round after round after round. You have these startup employees that joined, maybe haven't been making the largest salaries because they're working for a startup, but they have a lot of equity. I know there's been statistics about how many millionaires were created via the SpaceX IPO based on their early employees. An IPO is a time where a lot of people are able to sell. They're able to get cash finally for their shares that they might have been holding for a decade plus. Number three, there's an attractive valuation in public markets. And a lot of these things can tie together. So it would make sense that if founders and investors were looking to cash out, that they would do so at a time where valuations were attractive in the public markets. And that's where some of this IPO as a sign of a market top comes from, right? So if the founders are looking out at the public markets, they think, wow, we can get a really good price here. They're not going to sell or go public at a price that they think is inappropriate or too low. They're only going to do that at a price that is appropriate, or ideally for them, is actually overvaluing their company. There's some data here where companies the year after they IPO generally don't perform that well. But does that mean that it is a broader market issue, or is it a company-specific issue? And there's some more, I would call these secondary reasons. Shares are currency for potential acquisitions. So if you have publicly traded shares, it's much easier to acquire companies with shares. Increased brand visibility and credibility. SpaceX probably didn't need this just because Elon Musk runs the company and he's a very visible person. But as you can see, SpaceX has been in the news a lot based on this IPO. So an IPO can be a way to get your company in the news, get your brand a little bit more recognizable. increased employee recruiting and retention power. If you can offer shares that are immediately liquid and don't have long lockup periods, or private shares that you don't know if you're ever going to see the proceeds from, public shares are a little bit more attractive. And then generally, public companies tend to have a lower cost of capital. Again, I don't know if that's true anymore, as these companies in the private markets have gotten larger and larger and larger. But traditionally speaking, if you're in public and all of your financials are reported and audited, companies are going to be able to borrow money at lower costs. So, are IPOs a sign of a market top? Well, there's really two theories here. Theory number one comes from simple supply and demand. And we're going to explore both these theories in the following slides. So, if there's more equity available for investors to purchase, there's a limited supply of money to buy these equities. If more and more equities are put into the equity market, the supply is higher than the demand, the price of the overall market would fall. Okay, simple economic supply and demand. Theory number two, this sort of relates to reasons number 2 and 3 that I have on the long list, that IPOs equal market euphoria. That CEOs, founders, investors aren't going to make their companies public unless they think they're getting a really attractive valuation. So let's explore those two theories for the rest of the video. So theory number one, simple supply and demand. We're going to start with this bar chart here on the left. The supply of IPOs seems high. So here we're going to have the highest IPO value in 2026 expected that we've had since 2021. And we could potentially pass that number. But as you can see, it's going to be a number that's way higher than every other year over the past decade, except for 2021. So with that said, there's a huge amount of IPO value that's about to enter the equity market. Is that going to have a huge supply and demand issue from the supply side? Well, if you look, now there's tons of different ways to do this, so this isn't like an exact science. I just wanted to give you a general idea of what this would look like. If you plugged this entire annual IPO value right into the S&P 500, again, that doesn't really make sense. I'm just doing this so you can sort of understand the scale here. And then that new thing was the S&P 500. That new IPO value that we see here, the $250+ billion, would only make up 0.4% of the S&P 500. So it's just a tiny, tiny amount when you think about the scale of the entire stock market. Now, I use the S&P 500 because we've been talking about big companies, but that's not even, that's a very small portion of all the investable equities that exist. There's small caps, there's mid caps, there's foreign equities, there's tons of options, and not all of these sit in the S&P 500. So this is just basically to say that the supply, while it looks big compared to other IPO values, it does not look that large when you look at equities as a whole. Then what about the demand side? So I did a little bit of an analysis here. This was inspired by a JP Morgan report. They'd made this chart here on the left, the retail demand. It's basically net household demand for equities. So any given year, the Fed looks at if households are buying or selling equities. If they're buying, the number's positive. If they're selling, the number's negative. And I just put that over the total equity market. So the total market for corporate equities. And as you can see, over the last few years, it looks like about a decade, households have actually been net buyers of equities after being sellers for the decades prior. So retail demand for equity is strong right now. You look at buyback demand. Now, net demand for buybacks, what this is buybacks are positive in this chart, and equity issuance, or so issuing equity, is negative. So what this is really to say is net demand for buybacks has been positive over the last few years, minus a dip that looks like around COVID. But you can see at 1 year, it actually hit over 3% of the entire corporate equity market. Now you can see this line is trending down, and that hints back to what I said earlier with the Google equity issuance, that there might be more of an appetite now for issuing equity as opposed to buying it back. We're going to have to see. And then the foreign demand, yes, it is still positive. It's not as positive as it used to be. But when you combine these three things, right now, as of last year, the demand for buying equities, the net demand for buying equities across retail investors, so households, across corporations, buybacks, and foreign demand is all positive and strong. So there are still positive, strong demand for buying equities that could meet this incoming supply. So to sum this all up, supply doesn't seem like that big of an issue. There seems to be enough demand to eat up this IPO influx. So theory number one doesn't seem too convincing. However, that leads us to theory number two. And now quantitatively, it's a little bit hard to prove, is the market in euphoria? It could be in euphoria and it could stay in euphoria for a really, really long time. So there really isn't a timing component or perspective here. However, what I did do is since the year 2000, I went and grabbed the 8 largest IPOs based on proceeds raised. And you can see SpaceX, which raised $86 billion, was way larger than all of these. And I should say, this is just US IPOs. So companies that IPO'd on the US market. There were some bigger ones like Saudi Aramco that did not IPO on US markets. But what I did was I took the date of the IPO and then I looked at the S&P return 1 year after that date. And what you saw was kind of a mixed bag. So you can see the first 3 here, they're dated chronologically, or they're listed chronologically, not by proceeds. You had some of these that IPO'd right before big collapses, AT&T, Kraft, Visa, and then somewhat similar with Rivian here at the bottom of the screen. But then you have also something like Facebook, which IPO'd near the bottom of the tech bubble. So you can see the S&P performed really well after that IPO. There's not a lot of sample size here. I could have gone back years and years and years, but part of me, I wanted to fit this on a slide. But you can see the average return is -8%. I would discount this analysis a little bit just based on how small of a sample size this is. But it is something interesting to think about as we have 3 mega IPOs coming in 2026. If you look at the largest 8 since the year 2000, you have an average of -8% return 12 months later in the S&P 500. So let's actually look at some investment sentiment indicators to wrap up this video. And what you see is I just grabbed 2 ones that I look at periodically. So we have the CNN Fear and Greed Index here on the left that is currently sitting in fear. So they look at, I think, 8 or 10 different investor sentiment indicators and put them all up into one index here. You can see with this needle. And then I also looked at the AAII investor bull bear spread. I smoothed it over 3 months just to get it's a very volatile index. But basically it looks at the difference of people that are bullish versus bearish. It looks at retail investors in particular. And retail investors have actually been more bearish over the last few months than bullish. So the number has been negative. If I unsmoothed it, you would actually see that a little bit more clear, but you'd miss the shape of the whole chart. But taking these two things together, there's not a lot of signs, at least from the traditional investment sentiment indicators that we look at, that the market is currently in some euphoric state. So if you look at these two theories together, the simple supply and demand theory, not super convincing. The market euphoria theory, now the IPOs in themselves are potentially signs of not great returns, but right now the market does not seem that euphoric, despite the fact that we're hitting all-time highs and we're around all-time highs. So to sum this up, I can't predict the future, unfortunately, but me personally, I'm not freaking out that these IPOs necessarily mean a top in the market is around the corner. Now, that certainly could happen, but I don't think that these are a direct sign that this might happen. So that's what I'm going to leave you here today. I hope you enjoyed this video. I hope you learned something new. If you did, it could be awesome if you could subscribe to the channel, and I will see you next week for another Macro Monday video.